Happy Monday, everybody. Today is June 22nd, 2026, and this is your Monday market update. Now, I hope everyone had a meaningful Juneteenth long weekend. Some weeks, markets move on one big story. Last week, moved on three, and they all pulled in different directions. A historic peace deal, a surprisingly hawkish Federal Reserve, and a dramatic chip-led comeback to close things out. Despite all that volatility compressed into just 4 trading days, markets were closed Friday for Juneteenth. The major indices still managed to finish the week higher. That's actually a very important signal, and I want to make sure we break that down carefully. Now let's get back to the markets. Let's recap last week and let's preview the week ahead. The week opened with one of the most significant headlines of the year. Over the weekend, President Trump announced that the United States and Iran had reached a deal to end the conflict and that the Strait of Hormuz would reopen toll-free. Ships of the world, start your engines, Trump wrote, let the oil flow. Markets responded immediately. Oil fell nearly 5% on Monday to around $80 a barrel, the lowest since before the conflict began. And investors rushed into the sectors that have been most hurt by higher energy prices. That's airlines, cruise lines, and consumer-facing companies. They all surged. Technology stocks also climbed, fueled by continued enthusiasm around artificial intelligence. And SpaceX, which had debuted publicly the prior Friday with a 19% first-day gain, extended its rally for a second consecutive session, adding about another 20%. It was a broad, confident move higher. Investors weren't just reacting to the headline. They were pricing in what a sustained drop in oil prices means for inflation, for consumer spending, and ultimately for the Federal Reserve. The Dow was up 1%, the S&P up about 1.75%, and the Nasdaq up just over 3%. On Tuesday, the rotation story deepened. Oil prices kept falling. WTI crude dropped below $76 a barrel. The first settled below $80 for both major benchmarks since early March, and money continued moving from sectors that had benefited from conflict into one's position to benefit from its resolution. Industrials and financials led the way. Caterpillar and JP Morgan both rose meaningfully as investors bet that lower energy prices would re-accelerate economic activity. The Dow crossed over 52,000 for the first time in its history during the session, a notable milestone. But the flip side of that rotation was real pressure on chip stocks. AMD fell more than 17%. Micron dropped 6%. Broadcom 4%. NVIDIA shed more than 2%. SpaceX was the notable exception. Shares climbed another 5%, briefly pushing its market cap above Microsoft and Amazon. The Dow was up about 0.75% for another record close. The S&P down about 0.5%, and the Nasdaq was down about 1.25%. Midweek brought the most important event of the week, and that one was the one that caught markets most off guard. The Federal Reserve held its first policy meeting under new chairman Kevin Warsh, and while rates were left unchanged at the current rate of 3.5 to 3.75%, what came out of that meeting was decidedly more hawkish than markets expected. 9 of the 18 Federal Reserve officials now see at least one rate hike in 2026. The median year-end rate forecast moved up to 3.8% compared to 3.4% in March. Chairman Warsh abstained from submitting his own projection, an unusual move, but he made his priorities clear by repeatedly emphasizing the Fed's commitment to price stability throughout his press conference. That phrase, repeated deliberately, was Wall Street's signal that easy money is not coming anytime soon. Markets sold off sharply. Treasury yield surged, with the 2-year jumping more than 16 basis points in a single day. Technology and large cap growth names led the decline. The message to investors was simple. This is a Fed that is serious about inflation, and if the data doesn't cooperate, rates could go higher, not lower. The Dow was down about 1%, S&P down about 1.25%, the Nasdaq was down about 1.25%. Then Thursday showed exactly how quickly sentiment can turn. 2 things happened that reinvigorated risk appetite. First, the U.S.-Iran peace agreement was formally signed in Switzerland a full day ahead of schedule, and the Strait of Hormuz began officially reopening for energy traffic. That removed what had been one of the most significant macro overhangs for markets since February. Second, President Trump announced that Apple and Intel had agreed to partner on chip design here in the United States. Intel surged more than 10% on the news. NVIDIA gained about 3%. Micron jumped nearly 9%, and the broader semiconductor index climbed more than 6%. The combination of geopolitical resolution and renewed AI enthusiasm put buyers firmly back in control. The Dow was up just a fraction. The S&P 500 up about 1%. The Nasdaq was up about 2%, closing out a remarkable 4-day week. When you step back and look at the full week, it was defined by a tension between 2 powerful forces pulling in opposite directions. On one side, geopolitical resolution. The Iran deal is now formally signed. Oil fell nearly 10% for the week. That's an enormous development for the inflation outlook. Lower energy costs flow through to consumers, businesses, and transportation and manufacturing, and ultimately they give the Federal Reserve more room to breathe. On the other side, a surprisingly hawkish Fed. Chairman Warsh's debut made clear that the central bank is not pivoting towards rate cuts anytime soon. Half of the committee now sees at least one rate hike before the year's out. That's a meaningful shift from where expectations were just a few months ago. The fact that markets were able to absorb that tension and still finish the week positive tells you something important. Investors are betting that the peace dividend from falling oil prices ultimately outweighs the Fed's hawkish posture. That may well be right, but it's a thesis that needs to be tested, and the data this week will be the first real opportunity to confirm or challenge it. For the week, the Dow was up about 0.75%, S&P up about 0.75%, and the NASDAQ was up just over 2%. That marks the S&P 500's 11th winning week out of the last 12. Let's look under the sheets for a moment. Energy fell more than 6.5%, by far the worst performing sector, as oil prices plunged on the peace deal. Industrials led the way higher, gaining about 2.75%, followed by technology. Meanwhile, consumer staples, real estate, and healthcare each fell more than 2.75%, the kind of moves you'd expect when interest rates are rising and investors are rotating towards growth and cyclical exposure. The market is simultaneously celebrating the peace dividend and repricing for a Fed that may keep rates elevated longer than previously expected. Looking ahead, the focus shifts from geopolitics to economics. And this is a week with some real substance to it. There are no major economic releases today, but we do have our first Fed speaker of the week. This morning, Governor Chris Waller delivers an opening remarks at the conference on the international roles of the U.S. dollar here in Washington. Waller has been one of the most cautious voices on the committee. Back in late May, he said he is prepared to be patient on rates, but also made clear that he would not hesitate to support an increase in rates if inflation expectations start to become unanchored. His remarks today set the tone heading into a packed week of Fed commentary, so watch for any shift in language following last week's hawkish dot plot. Tomorrow brings the first real economic data of the week, the preliminary June PMI readings from S&P Global. We'll get both the manufacturing and services components. These are important because they are among the first June readings we'll have, and they'll give us an early signal of whether economic momentum is holding up in the wake of the Fed meeting and the oil price decline. Wednesday brings new home sales for May, along with building permits and the current account balance. Housing data has been mixed lately, and with the mortgage rates still elevated, investors will be watching to see whether falling oil prices are beginning to improve their consumers' financial picture enough to support home buying activity. Thursday is the week's main event, and it's a busy one. We'll get May personal income and spending report, along with the core PCE price index, which is the Fed's preferred measure of inflation. Goldman Sachs estimated core PCE came in around 0.31% for the month, which would put the year-over-year rate to roughly 3.4%, still well above the Fed's 2% target. This will be the first major inflation reading since Chairman Warsh's hawkish press conference. Markets are going to be watching very closely. If it comes in hotter than expected, it validates everything Warsh signaled. If it comes in softer, it raises real questions about whether the dot plot overstated the risk. Thursday also brings durable good orders and the third and final reading of the first quarter GDP, which Goldman Sachs expects will confirm growth around 1.5%, 1.6% to be exact. And Thursday has three Fed speakers worth paying close attention to. First, Governor Waller speaks again. Then in the afternoon, Fed President Williams from New York delivers keynote remarks in New York City. With some speech and Q&A. Williams is an FOMC voter, and he's worth watching closely because as recently as June 3rd, just 2 weeks ago, he said that monetary policy is exactly in the right place and that he sees no need to raise or lower rates right now. That was before the press conference. If Williams has shifted his tone, that tells you something significant about how the committee is evolving. That evening, Chicago Fed President Goolsbee is going to speak in Chicago with Q&A. Goolsbee's not a voter this year, but he has been very vocal. In May, he said inflation was making progress, then it stalled, and now the problem is getting worse. His take on last week's peace deal and falling oil prices will be interesting to hear. Friday wraps up with the final June reading of the University of Michigan Consumer Sentiment Survey, which tells us how everyday Americans are feeling about the economy, along with the goods trade balance and real inventories. And Minneapolis Fed President Kashkari is going to speak at the Aspen Ideas Festival. He is an FOMC voter. As recently as late May, said that it's premature to conclude that we need to be raising rates right away. And he wants to keep watching the data. Coming right after the Thursday's PCE report, his comments could be market moving if he signals any change in that view. Here's the setup for the week in simple terms. Market finished last week higher despite a hawkish Fed because investors are betting that falling oil prices will do more good than higher rates will do harm. Thursday's PCE report is the real test of this thesis, and the parade of Fed speakers this week, Waller, Williams, Goolsbee, Kashkari, will give us the first post-meeting read on how the committee is thinking about what comes next. Before we close, let me note that the longtime Federal Reserve Chairman Alan Greenspan has passed away at the age of 100. He will be missed. He had a great impact on the Fed and the economy. While many people will recall his irrational exuberance quote, I prefer a different one to explain the Fed and in many cases, many economists. He's been quoted as saying, if I've made myself too clear, you must have misunderstood. This pretty much says it all about the Fed. As always, stay focused on your plan, not the noise. Have a great week.